Hello, everyone. My name is Stella Primo, and we are getting ready to hear Curt Rocca talk about Beyond the CARES Act and PPP financing options for family businesses. Curt, thank you very much for taking the time out to present to us today. I really appreciate your efforts on behalf of all of the members of the Family Business Center. We're grateful for you to share your experience with us. Curt, why don't you go ahead and take it from here?
Okay, it's very much my pleasure to do so. Hopefully people can see my screen. And I think as Stella appropriately said, the theme of this session is beyond the CARES Act and the PPP. There's been a lot of focus on the CARES Act specifically, and most importantly and most frenetically around the PPP program, and a lot of small businesses wanting to make sure that they didn't miss out on the opportunity to capitalize on that. And I think the second round of the PPP funding is just cutting loose today. So if people missed out on the first go round, there's another window opening this morning, and hopefully everybody that should be taken care of will have the opportunity to be taken care of here in this second round. What we really wanted to talk about, let's see here, I'm not getting my screen to advance here. There we go. I guess before we talk about what we want to talk about, Family Business Center has a policy of making sure that when we give these types of presentations that everybody understands that we're trying to do the best that we can, providing information on highly complex and highly situationally dependent topics, and trying to do so to the best of our ability. But at the end of the day, these types of things tend to be very specific and sometimes ever changing. And sometimes there are a number of different exceptions, loopholes, and so on and so forth that you really owe it to yourselves to get true professional advice before actually making decisions that are critical to your business. So this slide really is advising you to please take what you've garnered from today's conversation and other conversations, and then take that as a catalyst and a stepping off point to get true professional advice on these important topics. So what we wanted to do is talk initially about what is the current situation. And I think it's fair to say that the existing COVID-19 pandemic and the related shelter-in-place orders have impacted virtually every business in California in one way or another. It's terrible. You read, we've all been to the supermarket. We see the fact that supermarkets are having a hard time keeping essential items on the shelf. And at the same time, you flip the page in the Wall Street Journal and the local newspaper or online, and you read about farmers disking under crops and dairy farmers throwing away perfectly good milk because the restaurants aren't using the same level of butter and cheese and other commodities. So, even the businesses where their volume is up are absolutely being impacted. So I think that by and large, the greatest, I think, questions that people are asking right now is, how do I best adapt my business operations and my value proposition to my customers in the short run to ensure that, number one, and what we're advising our companies in our private equity portfolio to do is, number one, make sure you understand how long your runway is. I was talking to, most of you know Steve Fleming. I was talking to Steve Fleming recently, and one of the things that he was saying is that one of the scenario that they like to have their clients look at is, let's just assume that this shelter-in-place order remained in effect, ad infinitum. Obviously, none of us hope and expect that would be the case, but it gives you a good litmus test for just understanding what your true worst-case scenario, or at least worst reasonable case scenario, would look like, and understand what that is, and then make sure that you do everything that you can to extend the length of that runway, right? Because the longer you have to make critical decisions, the longer you have to allow the economy to come back and return to whatever the new normal is going to be critically helpful. And then number two, don't just look at it from a perspective of, what do I need to just simply, hang on and not fall off the cliff, but what is the capital that I'm going to need in order to be able to truly capitalize on the significant opportunities that are likely to come about on the back end of this situation? I was talking to a company just the other day and sharing the story of one of the big lessons that we learned coming out of the 2008 recession was, so many companies cut too little, too late, that they made it through, but in virtually every case, they were looking back and saying, gee, I sure wish I would have cut more quickly and cut more deeply, because that $400,000, $500,000, $600,000, whatever the number was that I had at the time, I could sure use now, right? And they look back with regret, and that was one of the primary regrets. Secondly, and the harder one to answer for people is, what are the long-term systemic effects of the societal shock, and what changes do I need to make to adapt to this new normal? In other words, what is the future state that I need to be planning for? It's a little bit like the old Wayne Gretzky analogy. One of the things that they say made Wayne Gretzky such a great hockey player was his ability to anticipate where the puck was going to go and always be in the right place. And I think that's one of the big challenges that a lot of businesses are facing right now, with all of the different shifting tides that are happening concurrently, is understanding where their business is going, where their customers' priorities are evolving to, what the economic conditions, what interest rates are going to be. All those dynamics are all shifting concurrently. The Fed is taking unprecedented measures to try to mitigate the impact, which I think we can all agree would have been disastrous absent that. And so understanding what the right things to do long term is also becoming a challenge. And the longer you have, and that, getting back to point one, in maximizing that runway, the better off you're likely to be well positioned to capitalize on those long-term opportunities. So for today's agenda, really 5 things that we want to do. Number one, the situational assessment, which you just talked through. A quick review of the recently enacted loan programs that are out there. Talk a little bit about steps that some companies are taking to conserve cash, and one in particular, as well as to take good care of their employees. And then to talk a little bit about some additional financing sources that are out there that may or may not be applicable to you in your business as you think about the future. So this is a little bit of an assessment of where we are. I think right now on the left-hand side of this chasm there, there's a lot of uncertainty. A lot of companies are facing near-term challenges, and they're adapting in a variety of different ways. On the other side, they can clearly see, and it's not that far, they can see a promising future, wealth and prosperity, and what that new normal is for them and for their companies and for their customers. The hard part is just identifying what that new normal is likely to look like. And the CARES Act has gone a long, long way for most companies to enable them to cross over that chasm, not fall off the ledge, and get over to the promising future and the wealth and prosperity, and have the resources that they need to adapt to the new normal. What we're really going to focus on today is making sure that people are taking advantage of the CARES Act components that can get you to the other side, but also talking a little bit about, to the extent that that's not sufficient, what other opportunities there may be from a financing perspective that can augment what the CARES Act is providing to companies. So we'll start with the CARES Act. And really there are 3 primary components to it that we're going to talk about today. And one is the PPP loan program. It's available through banks. It's an SBA administered program, but the way to apply is through your local bank, and ideally your existing banking relationship. We're not going to spend a ton of time on that because so much time has been spent already, but certainly happy to answer any questions on the PPP program. It's most small businesses are eligible. They're up to 100% forgivable, and in essence, it's free money. The one thing I would say is, in order to be eligible for the PPP loan program, companies are supposed to have been adversely impacted by the COVID-19 situation. And there's not a clear definition on what adversely impacted means, but there you have it. I think, at least in principle, that's what the intention of that program is. The one that we haven't had as much visibility on is the Economic Impact Disaster Loan Program. And we are going to spend a little bit of time on that, but just at a high level, again, most small businesses are eligible. The one nuance is it cannot be used for the same purpose as the PPP. So the PPP program, and we're going to talk about it in a minute, so I won't go into too much detail here. The good news with the EIDL program is the first $10,000 comes to people immediately, well, immediately, as shortly as they can following the application being submitted. And that comes with no strings and no requirement to repay it. So there's a free $10,000 available for the EIDL program once it's submitted. Now, I have heard rumors that because of the vast number of applications, that they have reduced that. So they're now marketing it as up to $10,000. So I'm not sure what the new number is. I was told that from one company that they were only going to be receiving $1,000. So that's a question for the SBA that I haven't had an opportunity to dig into yet. And then lastly, the Main Street loan programs. And this is one that is also gotten through your banks. You can borrow up to 4 times EBITDA, your 2019 EBITDA to total debt ratio. It has a 4-year term. There's no payments required for the first 12 months. There are some fees and there are some limitations. And again, we're going to talk about all that in a little bit more detail here in just a second. So again, starting with the PPP program, there's not a lot to be said probably for this that you guys haven't at this point heard from others. You take roughly 2.5, well, not roughly, take exactly 2.5 times your monthly payroll, average monthly payroll. And there are a couple different ways you can go about calculating that. And that is the amount that you are eligible for. That's the maximum amount that you're eligible to apply for. The way you apply for a PPP loan is through your bank, again, ideally through your existing bank. It's an SBA administered program, but the banks are actually the ones who are in the process of doing the lending. The proceeds are supposed to be used for payroll, utilities, rent and mortgage payments, and interest on existing debt. So long as they are used, so long as the proceeds are used for those prescribed purposes, that amount can be 100% forgiven. Now, there are some limitations on that. At least 75% of the amount has to be used for payroll. But if you use at least 75% of the amount for payroll, the other 25% can be scattered around those other categories: utilities, rent and mortgage, etc. Even if it's not forgiven, it comes with a very low interest rate. It's a relatively short term. It's only a 2-year term. But a great program, and one that really any business that has been impacted in any material way really should apply for. I asked Heather with the SBA, who's the district manager for the SBA, to give me examples of companies that shouldn't apply for it, and she was really hard pressed to do that. So really, this is one that's designed to apply to virtually all businesses who've been adversely affected. That was the whole reason that the program was enacted. The next big question that everybody has, though, relative to the PPP program is, okay, now I have my funding. How do I maximize the amount of that PPP loan that can be forgiven so that I'm not find myself in a position of having to repay more than I would like to have to repay? And the good news there is we have a whole other webinar coming up on Wednesday. Riley Gardner with River City Bank, who has done an absolute fabulous job. He personally and River City Bank broadly of taking good care of their clients through this PPP situation, as well as Ben Brown with BFBA, who also has been a good advocate for helping to walk companies through this process. So hopefully, if you have questions about that, please tune in to the webinar on Wednesday. Because that's coming up so shortly on the tail end of this, I'm not going to spend any time, any meaningful time talking about this here. So moving along to the other 2 programs, the Economic Injury Disaster Loan, that is a loan program that you apply for directly with the SBA. Again, up to $10,000 comes to you very shortly after you apply. It is collateralized on all loans over $25,000, but you can get a loan of up to $200,000 without any kind of personal guarantee. Most of you have heard that SBA loans require a personal guarantee. In this particular case, there's an exception to that for loans up to $200,000. Loans above $200,000 fit into the traditional category and do require a personal guarantee. Nice thing is, though, again, unlike most SBA loans, It's a streamlined process and there are no fees to apply. It's a relatively low interest rate. It's a very long term, up to 30-year term. So it can be a great source of capital. Well, what else can I tell you? It's really to be used to satisfy what they call obligations that otherwise would have been payable if not for the COVID-19 impacts. One of the nuances that makes this one tough for a lot of companies to tap into is the proceeds cannot be used for the same purposes as the PPP loan. And since the PPP loan is forgivable and this is not, most people, when they're looking at the core of their expenses, they fall into what I would call PPP eligible categories, right? For most businesses, your most significant expense structure, expense items are tending to be payroll, rent or mortgage, interest, utilities. When you get beyond that, there's not a whole heck of a lot for a lot of companies to tap into. But for those where there is an additional appropriate use of proceeds, the EIDL might be something worth looking into. And the SBA is geared up and ready to help people through that process. The one that hasn't gotten nearly the same level of attention is the Main Street Loan Program. Again, go back to your existing or a new commercial bank. In this program, it's sort of a joint venture, if you will, between the SBA and the nation's banks. The way that it works is, in essence, the SBA takes on 95% of the risk associated with the loan, and the bank retains 5% of the loan. And so there's a risk sharing. So the banks are more likely to be willing to loan to companies under a Main Street Loan Program than they might otherwise be inclined to loan. So that's really where this is. As we go through the terms, I think that's what you'll see is, for those bankers who are on the phone, I know there are a couple, I think they would agree that in most cases, companies can simply just apply for a commercial loan. And as long as they have a secondary source of repayment, they're probably going to do just as well, maybe even better on a commercial banking facility than they would under the Main Street Loan Program. Where the Main Street Loan Program is helpful is where they maybe don't have that secondary source of repayment, where the bank is more inclined to be willing to take that level of risk. This one applies to larger companies. It's not just small companies. It's what they consider to be medium companies. Most of us on this call would consider these to be large companies, up to 10,000 employees. And there's also a revenue threshold, which is not wildly applicable to most people in the Sacramento region. I believe it's $2.5 billion in revenue. There are some upfront fees. It's 1% to 2% of the loan amount. Their minimum loan amount under the Main Street program is $1 million, but they can scale up to as much as $25 million. But again, keep in mind that that is capped out at a maximum of 4 times your 2019 EBITDA. So to put that in context, if in 2019 your earnings before interest, taxes, depreciation, and amortization was $2 million, that means that you could borrow up to $8 million on the Main Street Loan Program. It's a relatively low interest rate, roughly 2.5% to 4%. There are no payments required for the first 12 months. So for the first 12 months, it's a great way to, again, if you need additional help just to get across that chasm, and then life is going to open up and return to normal and good days will be here again, then this might be a good program for you. One of the downsides is it has a very short, or at least a relatively short term. It's only a 4-year term. And that's where I said before that in some cases, you may be better off just simply going to your bank and tapping into your existing commercial credit facility. Because what that means is if you're not making any payments for the first 12 months and the maturity is at the end of 4 years, that means you really have only 3 years to repay whatever the amount is that you've borrowed. And if you get back to, that example I gave, if the company is making $2.5 million, borrowed 8, or $2 million, borrowed 8, that level of debt service obligation can put a real constraint on the company's ability to grow during that time frame. So just something to be mindful of as you think through those various alternatives. One other point I wanted to make relative to the 4 times limitation on the debt to EBITDA ratio is that that is inclusive of all of a company's interest-bearing debt. So that would be not just for the Main Street Loan Program, but it would be also any line of credit or other term loan that you might have on the company's books. So wanted to make sure and clarify that one point. The nice thing, again, it's unsecured. So for those of you where that is of significant value, and that may or may not be different than what you might get under a traditional loan with your banking relationship. And there are some required conditions and restrictions. Number one is it must be for COVID-19 related items. 2, cannot be used to repay or refinance debt. You must make a reasonable effort to retain staff. Now, reasonable effort is a very broad term, and I don't think anybody understands what that means. Certainly no one's taken broad efforts to try to define it, but that is in the statute, so thought I would share that. And there are also compensation, share buyback, and other shareholder distribution restrictions. So to the extent that maintaining complete flexibility on those items is important, or to the extent that you currently have a share buyback program in place currently, it might be something to dig into on the front end of that process. I'd love to be able to ask for questions, but I think I have to wait till the end this time around. But I would say is if you do have questions, there is a chat bar down at the bottom. If you can use that to just submit your questions, that would be great. And then Stella at the tail end of the session will go through those with me, and happy to respond to any questions that people have. Okay. See if we can get this to go to the next slide here. Come on. There we go. One of the things, going to the next item on the agenda that I just wanted to cover, and this is a little bit off topic, but this is something else that people are looking at to try to figure out how they can reduce their expense structure in the most beneficial way to the company. Again, to that extending the length of your runway analogy and making sure that you preserve cash now where it's likely to not do a lot of good, and make sure you have as big a war chest as possible coming out the back end where you can redeploy it in highly strategic ways. And one of the greatest tools that sort of the government has given to us, and it's causing its own set of challenges on the back end, is the California Work-Share program. And just laid out a little bit of an example here to illustrate how you might think about using this. So for any of you who are in a position where you're needing to lay off staff, whether that's through a furlough, whether that's through a true layoff, or whatever mechanism you're using, California has something called the Work-Share program. We'll walk through a little bit about how that works. One of the things you'll see, there's a little note at the bottom of this slide that talks about the fact that you do, in order to take advantage of this program, you do need to contact EDD, you need to submit an application, you need to be approved through EDD. So this isn't something that you can hear today and start implementing tomorrow. You can hear today and start looking into tomorrow if you haven't done so already. But getting back to the top, so if you have an employee who's paid $20 an hour, easy math, $20 an hour, figure 40 hours, they're making $800 a week, right? Well, if you reduce that employee to 4 days, so you take them down to 32 hours at that same $20 an hour, that means you're paying them $640. So you've reduced your labor burden by 20%, which is not an insignificant amount. In order to qualify for the Work-Share program, you can actually go anywhere from 10% reduction in pay to 60%. So I've used 20% as the example, and I'll explain why in a minute. But you can do as much as a 60% reduction in the amount that someone is actually working. So you can, doing the math simply, you could take them down to 2 days a week. So assume you put that employee on 80% workday, so they're working 4 days instead of 5. They get $640 from the company. They also get $100, and that's a close number. I'm not representing that's exactly accurate, but I think it's relatively close to what someone would be entitled to receive through California unemployment insurance or unemployment assistance from the state of California. Then, as most of you may know, the federal government is augmenting what employees are able to get through the state unemployment through something they call the Federal Pandemic Unemployment Assistance Program, which extends through 7/31/2020. And the way that program works is employees get $600 per week for any period that they are entitled to receive at least $1 of state unemployment benefits. So you have an employee, and this is where it's causing unintended consequences, but you have an employee that when they were working full time was making $800 a week, now is making $640 plus $100 from the state plus $600 from the federal government. They're now making have the ability to make $1,340 per week versus the $800 they were working full time. So the employee in this scenario can make an additional $500 a week, and the employer saves 20% of your payroll cost. And again, I mentioned the reason that I used only a 20% reduction in time in this example is, if we circle back to the PPP discussion we were having a little earlier, you may remember the comment that 75% of the PPP loan proceeds must be used for payroll purposes in order to be forgiven. And so this 80% approach allows those employees to continue to be counted for the PPP calculation, so you're not sacrificing any loan forgiveness by going to the 80% number. If you go to 60% or something below that, then you may start to have challenges. And again, I would encourage you to seek your own tax and employment counsel on that, as well as just general accounting. One of the other benefits that this can have is it also gives you the ability to retain your relationship, assuming that you want to maintain this relationship with these employees coming out of the current lockdown environment. When the economy starts to open up, this gives you an opportunity to maintain that relationship with all 100% of your existing employees so that you can scale back up more quickly. Whereas if you laid off 20% of your employee base, then when it's time to scale back up, you may or may not have access to the same pool of talented and trained and known employees to scale back up with. So again, a bit of a digression, but it is still, I think, relevant to the content of how to extend the length of your runway. And I just know a lot of companies were trying to figure out, should I lay off? Should I furlough? Should I do work share? And so hopefully this analysis will be helpful to some degree as you're thinking through that for your own situation. So again, so you've done the work share, you've gotten your PPP, you've looked at some of these other alternatives. I want to talk about, what if that doesn't get you there? Even if it gets you to the other side of that chasm, it maybe leaves you a bit hamstrung or handicapped in your ability to actually have the business in the state that you really would like to have the business in coming out of this, to take advantage of the future growth opportunities, or even just to take care of the different priorities amongst the family, right? Because that's the other challenge in times like this for most family businesses is, a lot of the family members have divergent interests in terms of relying on on proceeds coming out of the company and distributions and other things. And when you come into situations like this, for most businesses, all bets are off. And the most important thing is how to do what's best for the company from a long-term sustainability standpoint. And so I wanted to talk a little bit about some of the different things you can do to further extend the runway. And again, most of that comes down to, how do you enhance your cash position? So number one, and always the best bet, is vendor financing, and try to extend your accounts payable. And what I've found to be the best way to do this, and certainly the approach that I've advised all of our companies to take, is to do it in a transparent way. people are much more inclined. I think if you reflect on how you react when your customers treat you in different ways, if you are honest and transparent and honorable in your communications with them, they're more inclined to be willing to work with you than if you go under a rock and try to hide. I think one of my banker friends likes to say, in the absence of facts, people hallucinate. And I think there's a great opportunity for a lot of hallucination to be going on right now. And the best way to avoid that is to communicate. So, and don't forget to include your landlords in those conversations. They're not going to like those conversations, but at the same time, they're getting used to them. And I would encourage you to engage with them on a proactive basis. The next best is customer financing, and these can be expensive, right? But focusing on especially customers where you may have some bad debt exposure, some of your customers that may not be as strong, or you suspect they may not have been as strong going into this cycle and this shock as some others, and giving them some incentive to put you at the top of the stack of who they pay will not only enhance your cash flow, but also further reduce your bad debt exposure, both of which can be really, really valuable in times like this. And then, require customer deposits for customers where you may have some credit concerns. Look at that and just be, whether it's requiring deposits, I think that's really there to say the most important thing is to proactively re-examine your credit policies and make sure that the people you're extending credit to are all still creditworthy. If you do need to look outside of your customers and your vendors, the variety of other outside, what I would call traditional financing sources, there are asset-based lenders. Again, your existing bank may have an asset-based facility. That is a scenario where people will lend based on your typically it's your current assets, it's your inventory and accounts receivable. In some cases, you may also be able to borrow against your equipment and fixed assets, depending on how marketable they believe that those assets might be in the most adverse scenario of a liquidation. So I would look into that. Accounts receivable factoring typically tends to be very, very expensive. But in this scenario, it's an opportunity where if people maybe are starting to get worried about your business or how much they can lend to you, accounts receivable factoring oftentimes is at least as interested, if not more interested, in the credit worthiness of the customer, because that's who they actually are relying on for payment as opposed to the company. So that's another area to look. The government, in addition to the CARES Act loans, also has some interesting financing opportunities. SBIR, Small Business Investment Research grants, are a great avenue. Unfortunately, those have a tendency to take a little bit of time, as does the STTR program, which is the Technology Transfer Research Program as well. Traditional SBA 7A loans, also available primarily through your bank, so you can talk to them. And there's a good website that I would point you to if this is something of further interest and something you want to dig deeper into. You can go to www.govloans.com, .gov, I'm sorry, not .com, but .gov, and there's a good list of resources that you can get there. There also is another really good resource list that we came across that talks about all the different kind of coronavirus response issues, and is a resource library for a broad array of those. It's published by the SBIA, which is the Small Business Industry Alliance, I believe, and they talk about health resources, safety resources, financial resources, all of the different components of how people are being impacted in this coronavirus response all in one place. So you can get that. We put that on our website just so it'd be easy for people to access. So go to dcapartners.com/agency-resources if that's of interest. The other is if you are holding on to, if you own your own real estate, there's an opportunity potentially, if it's of interest, to do a sale leaseback. There are companies that specialize in sale leasebacks with good, high quality companies. If that's of interest to any of you and you'd like an introduction to one of those companies, let me know. And Stella's going to circulate my contact info for those that don't have it. And I'm happy to make an introduction. It's not something that we do, but it's something where we have relationships with people that do that. And then the last is private capital, which is what we do. And want to spend a little bit of time talking about that. A lot of times I think family-owned businesses have a tendency to stay away from private capital sources, partly because of a perception that that would force the company to be sold sometime down the road, which oftentimes is the case. And it is a traditional exit because typically when private financing people like DCA Capital and others would invest in a company, one of the first things we want to know when we put money in is how do we get our money out? And oftentimes we will invest in companies because they are saying, gee, I really want to work hard for the next 5 years, but at the end of the next 5 years, my goal is really to sell it. And so we can partner with them to say, okay, we can help you shape the business and form the business in a way that's really going to optimize the value of the company over that 5-year period. And then we can partner with you in not only creating that value, but we can also partner with you on kind of extracting that value on the back end. But that's not the only way that we can get out. And so I think what we want to talk about is for those family businesses that do see an application for private capital, what that potentially could look like and whether or not it's something that you should consider. So I think I know a lot of the people who are on this call, but a little bit of background on DCA. And again, I'm using us as an example, not to either have this be a sales pitch, nor to suggest by any stretch of the imagination that we're the only ones that provide it. But it's easier for me to provide very specific and concrete examples when I use us to be sort of an illustrative example of what private capital could look like. So, the uses of private capital are broad and far-reaching. It could be, as you see in that center section, short-term cash flow crunch, which some companies may be going through, balance sheet deleveraging, where companies thought they had an appropriate amount of leverage with their bank, but all of a sudden things have changed dramatically and they need to take some stress off of the balance sheet. More interesting is the long-term growth and expansion. That's a very large part of what we do. The capital can be used to fund acquisitions, shareholder or partner buyouts, as well as wealth diversification and risk sharing. And there are primarily two different structures. On the left-hand side there, you see the equity investments, and that tends to be the one that most often requires a sale of the business or involves a sale of the company, or at least a portion of the company. And really, again, from an investor's perspective, all that the investor is really looking at is, what is my path to being able to extract my capital back so that I'm not a minority shareholder in a privately held company for the rest of my life? Because most private capital sources take in money from other people that also are looking to get a return within a 3 to 7 year time frame. So that tends to be the investment horizon that most private capital sources use to set the expectation with their portfolio companies in terms of the time horizon. However, unlike you mentioned, if you remember back, I was talking about the Main Street loan program, and one of the hard parts about that is just simply the debt burden that it places on the company. And with private capital, it's much more flexible in that regard. And on the equity side, in most cases, it doesn't extract any capital. So it doesn't provide any kind of a cash flow drain on the company whatsoever during the holding period. It's all about alignment of interests and creating long-term value. And so money comes in, everybody works hard hand in hand to try to maximize the value over that 3 to 7 year time frame. And then at the end of the 3 to 7 year time frame, the management team and the investor group have a kind of a pre-aligned decision and plan for how the company would like to see the investor being repaid. And that can be an outright sale of the company. That can be just a resale of the investor's portion. So you replace one private investor with a new private investor, and you just continue to recycle that over time. And that second investor can actually come in for more money, less money. So you can sort of, if the desire was to pay it back and have it return to being 100% family owned over time, there could be a path to doing that. There's actually an easier path to doing that under the subordinated loan structure, where again, you can have a current pay dividend, but there typically is no or a very small actual amortization of that loan. So let's just say, using our old example, you had an $8 million facility, the example I was using for the Main Street program, under a subordinated loan, even though the kind of the long-term interest rate would be considerably higher, the actual burden on the company would be significantly lower, because let's just say it had a 5% current pay requirement and no amortization. That means the company it would only cost the company $400,000 worth of cash on an annualized basis to continue to service that debt. And then at the maturity of that debt, which is typically around 5 years, the company can always prepay that in advance. But at the end of that, then typically what the company would do would be find another lender, either a senior lender, depending on how the company has performed. It may be that the company has enough senior debt capacity that they can refinance out the private capital with less expensive bank debt, or they can again bring in another subordinated debt lender to take the spot. From a governance standpoint, in both of those scenarios, whether it's equity or subordinated debt, management retains control. Typically, the lender, a subordinated lender, is going to piggyback on the covenants that the senior lender has. And so the senior, whatever your current bank covenants are likely to continue to prevail. So it doesn't provide a lot of the limitations and constrictions that sometimes the bank debt can provide, or specifically things like the Main Street loan program can have. One of the other differences is typically on the equity side. When people make an equity investment, they like to be on the board just to have a seat at the table. Doesn't mean they're in control of the board. In fact, using us as an example, we are almost never in control of the board. We just want to have a seat at the table so that we can be heard and weigh in on important issues that are facing companies. There are obviously certain provisions that would require our approval, much like you would expect with any other, at least most other minority shareholders. But in terms of control, that tends to stay with the company in either of those scenarios. So that is the private capital side of the capital stack. For those who think that might be helpful as you are either figuring out how to best build your bridge to cross that chasm, or as you think through what your business strategy is likely to be on the flip side. So with that, that's the end of the presentation itself. Stella, I'd like to maybe turn it over to you and have you let me know if there were any points I missed or points that people would appreciate clarification on, and happy to answer any questions to the best of my ability.
I do. I have a couple of questions for you. The first one is someone who's on the call who says that their bank only accepted applications for payroll salaries, but didn't permit the amount to be filed for rent. Can they apply for rent under the EIDL through the SBA?
Yeah, so there's a difference. The PPP program, it is the amount of the loan is determined exclusively based on the payroll, but the proceeds can be used for not just payroll, but payroll and rent and the utilities and other applicable kind of categories. It's a good question if the company uses, even though they're eligible to use the PPP program for some of those others, if they use 100% of it for payroll, would they have the ability and the flexibility to apply for the EIDL for the portion of the expenses that were not covered by that? I think it's a great question. I believe the answer to that should be yes, but I would be hesitant to say that definitively. So if whoever the question comes from wants to reach out to me, I will work to get them a definitive answer to that question directly from the SBA.
Thank you, Curt. I'll be sending a follow-up email with your contact information to all of the participants, and that way they will be able to reach out to you directly.
Okay, sounds good.
The next question is that you said the use work share at 80% because 75% of PPP proceeds must be for payroll, but that didn't compute. The 75% refers to the amount of the loan, which is 125% of an average month's payroll. So what does 80% do for you? And then there's a second question after that.
Okay.
So part two.
So I'm not sure I fully understood the question, but I think at a high level, the sentiment was that 75% of the there's two components to it. One is there is a provision that talks about in order for an individual employee to qualify for being included in the calculation for the loan forgiveness program, then they need to retain at least 75% of their compensation level during the time frame. So that's one of the reasons. The other is to the extent it's just sort of a safety net. If people want to go and do their own math, again, this is one of those situations where I think it's highly situational. People should do their own math and come to their own conclusions. And it may in fact be that the logic is somehow flawed, but I think using the 80% will certainly keep you above that threshold, both at the employee level as well as on the holistic company level. So that was the thinking behind that.
Excellent. The second part is if additional payroll isn't spent, then those unspent dollars will need to be repaid.
If additional payroll is not spent,
so I believe that if they didn't spend everything from their payroll, that they'd have to repay the balance of what they received to what was spent.
Well, again, it doesn't have to be just payroll. It's payroll plus those other qualifying expenses, right? But to the extent that payroll drops below, payroll cannot be less than 75% of the full amount. And so, you just have to be mindful of that if payroll drops below that, then everything else is going to be reduced as well. So, if you use, if payroll plus the other qualifying expenses subject to those limitations are less than the full loan amount, then the balance that is not forgiven will in fact need to be repaid. And that program has a 2-year term, and it's at 1%. So it's not like, if you look at it, it's not the end of the world. Obviously, you'd like to have it be completely forgiven, but at the end of the day, if you wind up having to pay a little bit of interest, at 1% and have access to the capital over the next 18 months, 2 years, but 18 months following the 6-month forbearance period, as cost of capital goes, that's a pretty good deal.
Excellent, thank you. Here's another question about PPP. So the payroll portion of forgiveness, you mentioned the 75% figure. Is that the max percentage to be used for forgiveness? That is, payroll or a minimum of your forgiveness has to be 75% of payroll, 25% other costs? For example, a company has a $100,000 loan. Could 90% be payroll and 90%
Absolutely.
forgiven?
Absolutely. I'm sorry, say the last part. Absolutely 90% can be payroll, 100% can be payroll.
Correct.
You know, for companies who are now the other thing that you know I need to clarify, you have 8 weeks to spend from the time that you get the dollars in. This is over 8 weeks, right? So again, if you do the math, you borrowed 2.5 months of payroll, right? And so now you only have 8 weeks to spend it. So that's less than 2 months, right? And so unless your payroll went up, it would be very difficult to have, you know, 90%, let's say, of the total amount go to payroll.
Thank you.
And again, there are also limitations in terms of highly compensated people. Things get capped out at 100,000. And again, I would suggest that. And again, I know this is huge on everybody's mind, and there's a lot of, unfortunately, there's still a lot of ambiguity in the marketplace, even from the experts. And had conversations with a number of bankers late last week who said, "Yeah, we get it. We're still trying to figure it out." But I think the best thing that people can do is really tune in on Wednesday, because I know both Ben Brown at BFBA and Riley Gardner at River City Bank are working tirelessly to get the best possible real-time answers that they can, so they can give as good guidance as they can.
Okay, we do have one more question. Somebody had applied with their bank, but there's no word yet on when the money is expected. They should probably just reach out directly to their banker on that one, correct?
Yes, reach out to your banker. And if I'm hopeful that all the different banks had different levels of approaches to the PPP program. And so I think in the first round, they had differing levels of success. But my sense is that they all knew that this second round was highly likely, and they all tried to learn from the challenges that they may have faced in the first round and have dramatically improved and enhanced their internal procedures. And so my sense is that if you have an application in, that hopefully within the next 48 hours, you will be able to get the most important step in the PPP loan program is to get an SBA number. In essence, what that means is the bank has approved your application, they've submitted to the SBA, and the SBA has accepted it as, they haven't approved it necessarily, but they've accepted the application as complete, and they are, in a sense, reserving the dollars for your application out of the pool. So that's what I would focus on, is ask your bank how long it will be before they can get you your SBA number. And if you hear something that's beyond 48 hours, I would be concerned, and I would start to look for other alternatives. And if you are stuck and frustrated, feel free to reach out to me, and I'm happy to do what I can to introduce you to some really good bankers, some of whom, looking down the list, I see are participating on this call.
Thank you, Curt. We have time for one more question. If someone decided to reduce hours and participate in the workshare program, would their salary employees be qualified for this benefit as well?
It's a great question, and it's one that we actually have had people look into. And I think the sense is yes, so long as you do it by days. Because keep in mind, salaried employees they're not hourly. So if someone works 1 minute, and again, I'm not an HR expert, I'm not trying to pretend to be, but my understanding is that if they even work 1 hour in a given day, or 1 minute in a given day, they worked that day, right? And so they're entitled to be paid. So what you really need to do in that scenario for salaried employees is to give them entire day chunks off. What the two companies that I know of who've looked into this the most deeply, though, have chosen to do is they have actually converted their salary employees all to hourly during this time frame. And that was advice that they got from a prominent HR consulting firm and law firm. And so I think what they determined was there was a little bit of uncertainty on the former approach, but the latter approach was crystal clear. And at least their view was, not my view, their view, but their view was that enabled salaried employees to qualify for the work-share program and qualify for the $600 per week federal pandemic unemployment assistance program, which is, meaningful.
Thank you. That is it for us with Curt. Thank you again, Curt, for sharing this. I'm going to be sending out the PowerPoint presentation that you gave to all of our attendees by the end of this afternoon. I wanted everybody to remember, as you've mentioned, Curt, that we have on Wednesday, you've received PPP funding. Now let's talk forgiveness with Riley Gardner and Ben Brown. So it's going to be on Wednesday afternoon at 2 in the afternoon. If you haven't registered, please do. I think we already have over 200 people registered for this really important webinar. Other than that, if anybody has any questions, always feel free to call me here at the office at 916-771-3220.
Good. Thanks, everybody.
Thank you.